Hello and welcome to the latest Expert Series webinar. Today's webinar is Germany, Driving the European Resurgence. This is a complimentary IndexUniverse webinar, courtesy of Deutsche Asset and Wealth Management. I'm Ollie Ludwig, the managing editor of IndexUniverse.com. We are the public face of IndexUniverse LLC, the leading authority on news and data about ETFs and the company behind Inside ETFs, the world's biggest ETF conference. Joining me today are two executives from Deutsche Bank, Heiko Peters, a Frankfurt-based economist with the macroeconomics team at DB Research, and Martin Kremenstein, a New York-based managing director and head of the firm's passive business in the Americas. We certainly have a lot to talk about today, but before we get started, I want you to know that you can ask questions at any time during the webinar in the window at the lower right of your screen. Also, the presentation will be available to all of you 24 to 48 hours following today's webinar. So let's get underway here. Germany has certainly garnered a lot of attention from investors since the Eurozone debt crisis first reared its head more than 3 years ago. In addition, currencies are in very sharp focus these days, given the influence of central banks in the macroeconomy since the market crashed 5 years ago. Now with the Fed signaling that it may taper its most recent round of quantitative easing later this year, the dollar may have additional upward pressure against the euro. Now against this backdrop, Deutsche Asset and Wealth Management's currency-related ETFs may be quite relevant to U.S. investors. Particularly germane to today's webinar is the DBX Tracker's MSCI Germany Hedge Equity Fund. It's listed on the New York Stock Exchange under the symbol DBGR. It was launched last month, and it is the hedge counterpart of the iShares MSCI Germany Index Fund, EWG. We'll certainly talk about that. It was the most popular fund last month among U.S.-listed securities. Now, DBGR, the Deutsche Bank security, may look increasingly attractive as a clean and accessible way to play Europe, focusing on its strongest economy in the context of relative euro weakness. Now, beyond Germany, Deutsche Asset and Wealth Management also markets another DBX Trackers product, DBEF, a riff on the EFA index, and it may well come into focus in today's webinar as well. But before we fully dive into Germany, I'd be remiss not to note that Deutsche Bank has also had success marketing its DBX Trackers MSCI Japan Hedge Equity Fund, DBJP, as Japanese policymakers, as we all know by now, have embarked on an aggressive campaign to weaken the yen. The beauty of DBJP's currency hedge is that while the yen has weakened against the dollar by around 15% this year, DBJP holders have so far been protected from that. Now, to be sure, monetary policy in Europe is very different than what's going on in Japan, but I bring up Japan to make clear that DBGB, the Germany security, will also insulate investors from any euro weakness relative to the dollars, and we will surely be focusing in on that euro-dollar cross over the next hour. So let's bring Germany back into focus, its economic might, and to the prospects for a broader European resurgence in mind, all, of course, in the context of the possibility of a weakening euro. So it's my pleasure to introduce to you today DB Heiko Peters. Heiko, take it away.
Yeah, thank you very much. Good evening from Frankfurt. Germany is, at the moment, Germany is the stability anchor of the Eurozone. Germany is the largest economy within the Eurozone. If you look at the share of the GDP, it's around 30%. And the population of the European Monetary Union is around 25%. So Germany is clearly at the moment the economic strongest and one of the largest economy of the Eurozone. If you look at the worldwide perspective, the share of Germany at world GDP is around 4%. And especially Germany is a relatively open economy with very high international competitiveness of the Germany, especially smaller and medium-sized companies, which are in small markets. They are the market leaders, and also the companies are highly integrated into global production chains, especially the integration especially high with Eastern Europe and Asia, especially China. And Germany is the third largest world trade share behind China and the US. And besides the very, very strong external sector, it has a stable domestic economy. So that makes Germany at the moment to the stability anchor of the Eurozone. If you look on the left side, you can see the GDP growth rates compared to the previous year of Germany and of the Eurozone without Germany. And what you can see here, that in the last years, Germany is outperforming the Eurozone. If you look at the historical series, you can see that this was different at the beginning of the 90s until mid-2000s, where the growth rates of Germany were lower compared to the growth rates of the monetary union. In mid-2000, Germany implemented a lot of reforms, especially on the labor market. And since around 2005, the German economy is outperforming if we exclude the crisis year of 2009, where because of the worsening of world trade, where Germany was hit especially hard, the growth rate of the German economy far exceeds the growth rate of other countries of the monetary union. Our forecast for this year is plus 0.1 for the German economy. If you compare it with the whole Eurozone, we expect a growth rate of -1. So it's clearly better position of the German economy at the moment, and we expect on the next year, we expect Germany to grow by around 1.5%. That's also way higher than the growth rate of the other countries of the monetary union. On the right side, you can see the development of the unemployment rate, and with the reforms Germany implemented in the mid-2000s, you can see that from the year 2005, where Germany had an unemployment rate of around 12%, the unemployment is steadily decreasing. And at the moment, it's on a 20-year low. And if we compare it with the other countries of the monetary union, especially worrisome level of the unemployment rate you can see in Greece and Spain, but also in the monetary union, if you exclude Germany, it's around almost 15%. So here you can clearly see the different situation of Germany compared to the other countries of the monetary union. And also, if you look at the development, if you compare Germany with the three other largest industrial economies of the world, you can see that after the deep and short recession in 2009, German economy recovered relatively quickly with the increase of the world trade in the year 2010-11. And at the moment, if you compare the level of the GDP with the pre-crisis level, you can see that the level for Germany and also for the US is higher before the crisis, despite the deep recession in the year 2009 for the German economy. So here you also can see within the largest industrial countries that Germany is in a relatively good situation. And then you can also see this again with the unemployment rate. We had only a temporary increase of the unemployment rate, and since 2009, after the crisis, we have a steady decline of the unemployment rate. And this, if you compare, for example, the situation of Germany with the situation on the labor market of the United States, before the crisis, the unemployment rate in Germany was steadily higher than in the United States, and this changed at the moment. So that from these points, you also can see the strength of the German economy. And also you can see it at the development of the world trade. You can see that the share on the left side, you can see the share in world trade of the largest countries of the world. You can see that the share of the German economy is relatively stable despite the market share gains of China since the end of the 90s. And so Germany is the third largest country with a world trade share of around 8%. And here you can see the structural advantage that the German economies have with a high international competitiveness. They are doing it with the integration into global production shares, that they are not losing market shares against other competitors. despite the integration of the emerging markets and especially China. And what you can see on the right side is that the share of export in GDP increased steadily since the early 90s, and you can see since the end of the 90s, you can see a widening gap between export and imports. So from then on, the German economy steadily has a positive growth contribution from net trade, and here you can see the relatively good situation that also has Germany on the international market and the positive growth contribution that Germany has from the strong international positions of the companies. What you can see with the sentiment indicators, which you can see on the left side, the manufacturing PMIs, you can see that after the deep recession, worldwide recession, the year 2009, the relatively strong recovery in the years 2010 and 11, you can see that we had to slow down again starting in 2010 with the debt crisis in the Eurozone, and until the end of last year, the sentiment indicators were declining, but if you look at the recent month, you can see an improvement of all the sentiment indicators, especially since the beginning of the year. On the right side, you can see the different sentiment indicators for the German economy. Here you can see with the yellow line, you can see the slowdown of the real GDP, that is the growth rate compared to the previous year. And you can see with the recent month of the sentiment indicators, you can see that real GDP should improve again. If you look at the quarterly growth rates, then because of the slowdown of world trade, especially the fourth quarter of last year was relatively weak. In the first quarter this year, we had also a negative impact from negative growth contribution from net exports especially. What's relatively stable in Germany is the growth contribution from domestic demand, especially from the private consumption. And that's one of the main reasons we expect that we see an improvement in the economic situation of Germany in the next couple of months, and you can also see this if you look at the improvement of the sentiment indicators. So what are the main reasons that changed in the mid-2000s that from the economists called at the end of the 90s, the economists called Germany the sick man of Europe. Now it seems to be that Germany is the new poster child and one of the strongest economies in the Eurozone. And the main reasons for this change is that Germany implemented a lot of reforms in the mid-2000s. The first part I already mentioned is the structural reforms on the labor market, which improved all the flows that you have between employment and non-employment and the flexibility of the companies. Since then, it's possible, it's possible that the companies could, if they see a slowdown of demand, they can adjust their working time relatively quickly, and so that's one of the main reasons for the stability that you could see it on the labor market in the year 2009, that the company, especially in the manufacturing sector, decreased the working time, and then directly in the year 2010 and 2011, when global demand started to come back, all the workers stayed within the company and could immediately start producing again. So these flexibility on the labor market, that's one part of what become possible after the implementation of the labor market reform, make the manufacturing sector very flexible with the hourly change of the working time. The other part is that the companies, and the German companies, especially the small and medium-sized companies, integrated into global production change starting at the end of the 90s, and the main integration was with countries of Eastern Europe and also with Asia. So with the relatively high wages in Germany, the companies relocated parts of their production into these countries, and so the whole wage level for each of the company was coming down because of the lower wage levels in Eastern Europe and also in China. So that's one reason why the German companies are so competitive, and that they started relatively early to integrate into the global production chain. And this is the only way to, one of the only way to, for the small and medium-sized companies, the so-called German Mittelstand, that they have the possibility to benefit from scale effects if they are integrated into global production chains. So that is one part of the strength of the German companies in the manufacturing sector. And the third part for the relatively good situation is that we did not see a housing bubble in Germany because of a relatively strict regulation of the housing market. And the debt level of the private households are relatively low if you compare this with the situation in other countries, especially with the countries that had a housing bubble. So that's the third part, that it's not necessary in Germany that we have to adjust the balance sheets of the private sector. What you can see if you look at the two growth components of GDP, the first one of private consumption, we expect it to be the major growth contributor this year and also the next year. One reason is that employment is on a historical peak level at the moment. You can see it at the left side that employment increased steadily since the implementation of the labor market reforms and all the flexibility that made it possible for the companies to increase the employment. And on the opposite side, you can see that unemployment is steadily declining since 2005, and unemployment is at the moment on the lowest level since about 20 years. And what you can also see is that the earnings are increasing this year. We expect it to be on a nominal level of around 3%. If you look at the real wage growth, it should be around 1.5%. This year we also expect it to be around this level the next year, with a good situation on the labor market with high employment and positive growth rates of real earnings. We expect this to be the main causes that private consumption is relatively stable and relatively strong this year and also the next year. And the other part is what you could see with all the challenges that we have in the Eurozone, with the declining external demand from other countries of the monetary union. You can see on the left side the German export by region. You can see with the green light that the level of the exports to other countries of the monetary union is below the level of the previous year, and export to these countries are relatively weak. What you could see in the last year is that this weak development of exports in other countries of the monetary union was overcompensated by export from Germany into Asia and also into the United States, so that in last year the annual growth rate of export was still positive. And if you look at the latest numbers, you can see that there's a recovery of export going to the United States, and you also see that the exports to Asia should have reached the bottom some months ago, and they are also recovering. The dotted lines are the sentiment indicators, and these are pointing to an improvement of exports. And so we expect that after the relatively weak winter half year, we expect in the course of the second half year that export should recover, and from the external side we should see positive growth effects for the German economy. And on the right side you can see the share share of the trade balance, and you can see that that non-EMU countries are getting more and more important for the German companies as a destination for their exports, and so that the German companies are in the very tough international waters at the moment. They make it to choose new destination countries, so they still have a relatively good export performance at the moment, which should improve in the course of this year. And what you can also see, beside the relatively strong private consumption and recovery of export, and so an improvement from the external sectors, you can see that no adjustments are necessary for rebalancing of the balance sheets. If you look at the different sectors of the German economy, if you look at the government debt level, the debt level of the households, and also at the debt levels of the companies, you see that they are on a sustainable level, and so Germany does not need, like the other countries, for example, the housing bubble or relatively high debt levels of the corporate or government sectors. Germany does not need these adjustments, and so there's no negative effect from a balance sheet adjustment that we see for the German economy. You can see the fiscal position of the public sector. You can see that at the moment the debt level is stabilizing at around 80%, and in the year 2012 we can see that the budget, we see a budget surplus again, and so Germany's government sector is on a sustainable level, and with a relatively low budget deficit that we expect this year, and the last year they're around zero. So the German government with the public spending is a very good situation, sustainable situation, that we do not need adjustments on the debt level. The other part is, if you look at the other sectors, if you look at non-financial corporations, if you look at households, you can see these on the right side as a percentage of GDP. You see that the debt level of non-financial corporations is relatively stable at around 150%, and the debt level of the households is decreasing steadily since the beginning of the 2000s. The only debt level that increased at the share of GDP was the public sector, but this because of higher spending due to the crisis in the year 2009, and some other parts are rescue money for the peripheral countries with the rescue packages from the Eurozone. And if you look on the left side, you can see the debt level of German household as a percentage of disposable income, and with the relatively strong increase of disposable income, the debt level of the households is coming down. So here you can see the sustainable situations of all the different sectors of the German economy. That is one further strength of the German economy. So to sum up the results, we expect that Germany will outperform the other countries of the monetary union, and the one part is with the recovery of the external sector. One part is that the worldwide demand should come back in the second half of this year. We expect relatively strong recovery in the United States in the second half year, and also recovery in China. And with these two regions recover, and with the higher external demand from these covers, especially the German companies should benefit by higher exports in these regions. One further effect is that we expect the euro to weaken in the next month and also in the next years. We expect that the US dollar will reach parity against the euro by 2017. So we expect a steadily declining of the weakness of the euro in the next year, and this also should have a positive effect of German export and then on the German economy. That's also on the medium term. And the other part of the success story of Germany at the moment is the relatively stable domestic demand with a good situation on private consumption, the good situation on the labor market, and also with the rise of real income. We expect that the German economy will benefit from relatively robust domestic economy, and that is one reason for the stability at the moment. If you look at the growth rates for this year, we expect Germany to increase by GDP to increase by 0.1%. One reason for the relatively weak numbers, the weak winter half year, especially the weak fourth quarter of last year. If you look at the carryover effect from last year to this year, it's around minus 0.5%. So if you look at the growth, if you exclude these carryover effects, so the real growth rate, so-called, if you call it so, it's around 0.5% this year. And with the recovery in the second half year that we expect, we should see a growth rate of around 1.5% the next year. That is about the potential growth rate of the German economy. So we are very optimistic on the German economy because of all the structural, very good situation on the structural side. Germany already implemented all the necessary reforms in the mid-2000s, and also we do not see high debt level on the different sectors of the economy. That was my part of the presentation. Thank you very much for your attention. I will be available for questions later, and now I will pass to Martin. Thank you.
Thank you very much, Heike. I think it's very clear from the data that you've given us from your presentation that investing in Germany, or certainly investors should take a look at Germany as a market to invest in. I think then the question is, how does someone invest in Germany in the most efficient and the kind of the cleverest way of doing it? Just going to flick through my slides relatively quickly for you all. Deutsche Asset Wealth Management is a top 5 ETF issuer globally. We're one of only 2 ETF issuers that has a significant presence on both sides of the Atlantic. We have around $12 billion of assets with around 55 products listed in the US. And globally we have about 65 billion, as I said. We have a history of building innovative and value-added solutions. Our first products that we brought to market were the products that we market with PowerShares, the PowerShares DB commodity and currency lineup. And not only did those give access to the commodity markets for the first time, they also did it in a way that enabled investors to best manage the roll effects of investing in futures. And so this is kind of the backdrop that we build our products with, is this idea of building value-added products through the innovation that comes from being in an institution like Deutsche Bank. The full lineup of funds that we have available in the US, to the right you can see the PowerShares DB products, and on the left we have the DBX trackers products. We have a product there, the MSCI Germany Hedged Equity Fund, ticker DBGR. That's the product I'm going to talk about in a minute. It joins the rest of our international currency hedged equity lineup. A few years back we teamed up with MSCI to help them build currency hedged versions of their benchmark indices. The idea behind it was that this was back in 2009, that the dollar had been on this long-term decline against most major currencies, and indeed a lot of emerging market currencies. It was like a 10-year decline, and people were looking for the turn. And so we wanted to have product ready and available for investors when that turn came. We launched 4 of them back in 2011, the Brazil product, the EFA product, emerging markets, in Japan. I think the Japan one is the one that's garnered a lot of attention in terms of its returns year to date. I think it's been the best performing ETF available to US investors year to date. That's DBJP, and it's outperformed its unhedged equivalents because it has a hedge. It's also outperformed its hedged equivalents because it offers benchmark exposure to Japan. And that's one of the key things that we wanted to do with these products. So moving forward, this is the line up there. You can see the bottom product there, DBGR. It's got a management fee of 50 basis points. So again, you're not paying, compared to unhedged products, any kind of premium for running the currency hedge over the product. So again, why Germany, and why a hedged currency product? I think the PE ratios are very attractive. The dividend yields are very attractive in Germany at this point in time, and as Heiko has been explained to us for the last 20-30 minutes or so, the outlook for Germany looks very, very positive. However, the outlook for the euro is not so positive. And if you combine his positive growth story in exports and earnings for German companies with this projection of parity for the euro back to the dollar in 2017, any investment in German equities that doesn't involve a hedge against the euro is going to suffer massive headwinds. And it wouldn't be out of the ordinary to see those headwinds, and that performance differential between hedged and unhedged look very similar to the performance differential that we've seen in Japanese products between the hedged and unhedged. And so I think if anyone who wants to take a position in Germany for the long term, they have to be mindful of the fact that the euro is currently at 130. I think we have it going somewhere between 112 to 115 by the end of 2015, and going back to parity by the end of 2017. If you don't hedge out that currency exposure, it's going to be very, very hard for the positive returns really to feed back into your portfolio. And then the final, I think, benefit from currency hedging in Germany is obviously this reduction in volatility. If you look in the bottom right-hand corner, you can see that over prolonged periods, hedging out the currency exposure, hedging out the euro exposure on a German equity basket has actually reduced volatility by somewhere between 20 to 30%. Which is a huge reduction in volatility, and obviously that would translate into better kind of performance ratios in your portfolio. I think it's probably a good time also to mention DBEF, which is our EFA basket. Obviously, Germany is a fair component of that EFA basket. In fact, in general, the EFA basket is about 70% invested in euro and euro correlating currency equities. So that's Euroland, the UK, and Switzerland as well. And again, any kind of developed markets EFA type investment, I think you do need to look at the risk of currency declines versus the US dollar. In fact, the DBEF has outperformed its unhedged counterparts year to date by somewhere around 7 or 8%. So that's just real-time experience of the currency hedge really kind of paying off for investors. With that, I'm going to pass it back to Ollie now. He's going to open up the line to questions.
Thank you, Martin, and thank you, Heiko. Certainly we have some questions that have come in, and fasten your seatbelts. There's going to be a little bit of skepticism coming your way. Just before we get into that, though, Martin, as long as you were talking very specifically about the currency hedge, can you explain a little bit the mechanics of the hedge itself and the security, the DBGR, right?
Yeah, sure. So DBGR, it's essentially very much, it works exactly the same as its unhedged MSCI equivalent, EWG. So it goes out and it buys the underlying equities that are in the MSCI Germany index. There's about 52 or 53 equities. And then it goes and buys a 1-month FX forward, which is selling the euro and buying the dollar on a 1-month basis. So if you think about it, when you take your dollars and you buy German equities, you've had to do a currency transaction into euro in order to buy them. And then once you've bought the equities, you then enter into a currency forward on a 1-month basis in order to bring that currency exposure to the euro back to zero. We use 1-month forwards because they're very, very liquid, and they also limit the amount of counterparty exposure that you have. If you roll them every month, there's very little opportunity for a big mark-to-market to build up versus the counterparties. And the counterparties we use are all very, very kind of standard, large, dull banks, if you like. So we limit the counterparty, the counterparty risk from that forward in those two ways. One by limiting the duration, and then one by kind of managing who the counterparties are.
Okay, now let's continue in this granular mode just for a moment before we get back to the macro economy and bring Heiko back into the discussion. But talk about the optimization of the portfolio. You talked about it being very similar to the index that underlies EWG. Can you speak to that a little bit and how they fit together, how they dovetail together?
Sure. I mean, to be honest, apart from the currency hedge, they're virtually identical. The fact of the matter is, the index, the MSCI index, is extremely investable to a very granular level, and so we although the fund is new and still small, we haven't had the need to optimize the index. So what you're getting is optimize the basket. So what you're getting is very, very, very tight tracking to the index because we're matching it almost perfectly.
Right. Okay. Now, I want to make sure that I understand the thesis you guys are putting forth about the weakening euro going forward. I think Heiko said parity in 2017. And if I'm understanding you right, you're basically saying the rest of the eurozone is sort of not well. Germany is well. The euro weakens because the rest of the eurozone and Germany continues to chug along. Is that oversimplistic, or is that what you guys have said?
Yeah, that's correct. The reason for the weakening of the euro that we expect, the one part is that we expect the U.S. economy to recover relatively strongly, starting in the second half of this year, and then the next years to grow with a relatively strong growth rate. For the next year, we expect for the U.S. economy around 3% real GDP growth. And if you look at the eurozone, then you can see that the peripheral countries are they're in a deep recession at the moment. And if you look at the sentiment indicators, we should see some improvements in the coming months, so that for the eurozone as a whole, we see maybe in the second half of this year, we see around stagnation. But if you look at the first quarter and the quarters before, we saw 6 consecutive declines of GDP for the eurozone at the whole, and with a weak situation of the peripheral countries, and also some of the other larger economies besides Germany, which are also see declines of the quarterly GDP growth rates. The monetary policy of the ECB is very expansionary, and in the latest press conference of the ECB, President Mario Draghi highlighted that the monetary policy will remain very expansionary, and that the interest rates that are at a historical low level of 0.5% at the moment, the key interest rate, should stay at this level for extended period of time. And with the weakening of the euro and the relatively low interest rates, this should have a positive effect on the German economy.
Yeah, and I think to add to what Heiko just said, I mean, if you looked at if you're watching his presentation, he was highlighting a German stabilization and kind of recovering, strong recovery, and this was even as a lot of its neighbor countries and neighbor markets were experiencing deep recession. If you get a stabilization there, obviously that's going to help Germany some more, but more importantly, we saw the growth of non-EMU markets as a share of German exports, and that's key because as the euro weakens, obviously the euro weakening doesn't really help you with your trade difference, your trade advantage versus say an Italian or a Spanish company, or selling in Italian or Spanish markets, but it certainly helps when selling in the US or selling in Asia. What you get a couple of things. First of all, German companies, from what I can see, don't tend to massively compete on price. They tend to compete on quality and specialization. But even then, with that said, the fact that the euro is weakening is going to make their products more competitive from a price perspective. But it also just means that they're going to be bringing home higher profitability in their home currency, and that should affect their equity. But again, if you haven't hedged out the currency exposure, you will see a lot of that start to dissipate with the decline of the euro.
Okay, thank you. Now let's talk about the monetary policy. I think, Heiko, you said a moment ago you expect monetary policy to remain relatively steady in the near future. I'm wondering if you might comment as to how a rate hike would course through the entire eurozone, and how it might affect what you're arguing here this afternoon.
Yeah, if you look at the monetary policy, then I think it's clear at the moment that you won't see an increase of the key interest rate in the foreseeable future. That's totally clear, made clear by Draghi with their forward guidance that they implemented for the first time at the last meeting. And it's clear that the key interest rate will stay at the very low level at the moment. And if you calculate with the current economic situation of Germany at the moment, if you would calculate the optimal key interest rate, then it would be at the moment around 3% for the German economy if you calculate it with a simple Taylor rule. And so from these calculations you can see that from the low key interest rate and low interest levels, the domestic demand, especially also the construction sector, is benefiting from the low interest rates. And from these we see a positive effect on the domestic demand, and we expect it to be in the foreseeable future, because the ECB, if the ECB would start thinking about to increase the key interest rate, this would harm the peripheral country that much. So I think that's not possible at the moment.
Okay. Now, there are a lot of questions coming in right now from audience members about the elections in Germany later this year. And Heiko, if you might comment on how the various outcomes there might affect what you're talking about here, one way or the other, Merkel versus Steinbrück, right? And is there a preference there? Does your outlook is it predicated on one being the victor versus the other, or are you agnostic on this issue?
What do you see in the polls at the moment, and if you see the development in the last weeks, you can see that the CDU, the party of Chancellor Merkel, is gaining shares at the polls. They're at the moment at slightly above 40%. And so it's at the moment, if you look at the polls, then the most possible outcome would be that the CDU will be the strongest party and that we will see Merkel as the chancellor again. And this would imply that the whole part on the whole European policy part that's done from the German politics, and we expect it to continue. In the course that we also saw in the last year, and that this policy will continue. So,
thank you. Go ahead. I interrupt someone. Okay, Martin, I want to bring you back in here. This question is a bit more granular, so bear with me. Obviously, Germany is an export powerhouse, and its economy, correct me if I'm wrong, tends to be inversely related to the strength of the euro, and intuitively it would appear that hedging the currency exposure might increase volatility, and I'm wondering if you might explain why you think hedging to the euro reduces volatility, please.
Well, hedging back to the US dollar reduces volatility in all instances except for in Japanese yen and possibly in the Swiss franc. And the reason is because in a big sell-off, you get a flight to quality. And the flight to quality currencies are the US dollar, the Japanese yen, and the Swiss franc. And I think the key example of how that is when S&P downgraded the US government debt, and there was a flight to quality, people bought the dollar and it strengthened. And so, with the exception of the Japanese yen, the products that are available in the marketplace, all other hedging strategies are going to reduce your volatility because they massively reduce the downdraft that you get during a sell-off. So that's really, it's more of just a technical market thing that it reduces volatility that way. Okay,
thank you. Now there are some doubtful questions about just how bad it could get in the eurozone. Let me just start with the most dire scenario. Heiko, in your judgment, is there any possibility, however remote that it might be, that the EU would come apart? And if so, how would you see the German economy playing out? It's a hypothetical for sure, but it's coming through in the questions here, so I would be remiss if I did not ask it.
Mm-hmm. What we saw in the middle of last year, we had this discussion on maybe that the eurozone that you could see a breakup of the eurozone and the eurozone will fall apart. But then in the middle of last year, the ECB stepped in with an outright monetary transaction program announcement, and this was a kind of backstop since then that we saw the stabilization on the financial market And at the moment, what's lagging a little bit behind for the whole Eurozone, we also see an improvement, slight improvement on the, if you look on the real economic data on the monthly basis, we also see some sign of starting very moderate recovery in the Eurozone. And this is one backstop that the ECB is ready, like Draghi put it, to do whatever it takes to save the Eurozone, if you can call it like this. And
you're referring to what Draghi said about a year ago in July of 2012.
Yeah.
Okay, fair enough.
And with the announcements of the OMT program, and also the ECB is also providing a lot of liquidity to the banks and to the peripheral countries via emergency lending assistance and some other liquidity injections. So we have one part is the ECB, and the other part is that we see from a political level that there are also from Germany and also the other core country, there's the strong political will to hold the Eurozone together, and also with the available rescue packages. While the ESM, there's at the moment around 400 billion left for maybe in the future for further rescue programs. So with these backstops that are in a kind of buying time for the peripheral countries to implement the structural reforms, rebalancing the economy, we're expecting that with the OMT, the rescue packages and the political will, we expect that this is buying time, that the peripheral countries are getting the time to rebalance the economy, and so we see we don't expect that we have this discussion we had a half year ago again.
Well, here's another question, sort of in the same vein, Heiko. Considering that a lot of the debt from the weaker countries is held by German banks, there was this sentiment, certainly before Draghi made his famous stand a year ago, that there was not possibly enough money in Germany to cover all these obligations. And this question here centers on the fact that a lot of these German banks are holding this debt. How does that affect Germany? Is your answer from a moment ago applicable to this particular contingency? This is more in the realm of private banks, right?
If you look at the debt level that German banks have from other European countries, especially from the peripheral countries, you can see they reduced it markedly in the last years. But it's still relatively high. And what we can see is with the liquidity injection from the ECB, and also with the rescue packages and the recapitalization of the banks in the peripheral countries, we see a stabilization of the situation on the financial markets, and we expect that this policy course will continue. And what is planned that will start is the single supervisory mechanism, that we have a banking supervision on the level of the ECB next year. And also what is planned is a banking union in the future, and this would in kind of tackle the problems of the banking sector. And with the improvement on the banking sector on the peripheral countries, we also see then that we solve the vicious cycle between the debt or the problems in the banking sector and the problems of the government debt or the governments in the peripheral countries.
Okay, now let's take this discussion. There are a number of questions here that are looking more broadly outside of the Eurozone as it relates to Germany. Let's start with some of the more dour questions, casting doubts on your discussions about accelerating growth in the United States and in China. The U.S. has just revised its first quarter GDP back. China, it's sort of perhaps a great mystery, certainly not what it was before at this point in time. All of this would seem to have some very tangible effect on what the German economy can achieve if indeed growth globally is on the verge of slowing. Can you comment on how you regard these sorts of alternative forecasts, if you will?
Yeah, if you look at the situation in the United States, indeed you saw the very weak with the downward revision of the first quarter, and we also see probably a relatively weak second quarter. but then we in the third and fourth quarter we expect a recovery. One reason for this is an continued improvement on the housing market, and we also expect a relatively strong car sector, and also a further improvement on the labor market. And with these factors, we expect that we'll see a relatively strong recovery in the second half year. For China, we saw the latest data relatively weak, especially from what we got this week with the trade data that were relatively weak, and we saw a downward revision of the growth forecast. But the government target for the growth rate around 7.5%. We expected this year to be slightly above this, and we expect that if we see further weakening of the economic data in the coming data points, then we expect that we see some impulse from the government side and also from the monetary policy that would give kind of boost to the economy.
Okay. And another sort of macro question involving the global economy. We have a question here. The emergence of a more price competitive Japan, what its impact on the German economy might be. It seems possible that any Japanese gains might be made at the expense of German exports. How do you view that possibility?
I wrote a note on this some weeks ago, and we looked at the different export markets where German companies have their destination countries, and also Japanese companies, and they're not most of the part they're not competing at the same markets, and because a lot of exports are still going from Germany to other countries of the monetary union, and also to the countries of the European Union, the other countries of the European Union. The most, and if you look at the regional export structure of Japanese exports, the most parts are staying within Asia. And this is one part because of different regional markets. We also see the highest competition between these exporters in the car sector. And there, if you look at the sector directly, German car companies are especially producing or especially strong in the high price segment, and the Japanese car producers are relatively strong in the volume sectors. So also here you don't expect that the competition would be relatively strong.
Okay, and let's see, there is one more on the macro side, and we'll come back to you, Mark, because there are some very specific questions about DBGR that I think you're probably uniquely qualified to answer. There's a proposed free trade zone arrangement between the U.S. and the Eurozone. Heiko, in your judgment, will that make Germany decouple even more from the rest of the Eurozone if this goes through, and trade relations between the United States and Germany are... I guess the question is, how would Germany's be affected by this U.S. Eurozone agreement if it indeed is implemented?
Yeah, indeed, this would especially boost the exports or the trade between Germany and the United States, and this would even improve widen the divergence between Germany and the other countries of the monetary union. And that's one part is the reduction of tariffs, the other part is a reduction of non-tariff measures. And what's crucial is that with all the reduction, especially of the non-tariff measures, that we do not risk because of an harmonization at the non-tariff measures or so between the United States and Germany, that we don't risk that with this harmonization of some rules or so, that we don't interrupt the production change, international global production change, for example, between German and Chinese companies. So this would be one risk for the situation. But if you look at only on the trade agreement between the United States and Germany, that would boost exports and trade between these two countries.
Right. Okay. Well, thank you. Now, I wanted to circle back to you now, Martin, with regards to the DBGR. currency hedged German ETF. What is the average daily volume for DBGR? These are questions pertains to the tradability, and what is the current yield of the security?
Okay, so the ADV at the moment is low. It's around 1,000 shares a day, simply because it's a new product that's still getting off the ground. I'm looking now, the bid offer on it maybe 6 cents wide. So liquidity is there, but I would agree you should probably use limit orders when investing. And then with regards to the dividend yield, it's around 3%. So it's the dividend yield of the underlying index is about 3%.
Okay, and let's talk about the index here for a moment. There's a question here pertaining to sector weights within the MSCI Germany index. Specifically, exposure to banks. Can you speak to that a little bit? There's certainly a continuing concern about that, particularly as it relates to German banks for the reasons we've been talking about here, carrying a lot of debt that perhaps they would rather not be carrying.
Yeah, funnily enough, there isn't actually a huge amount of exposure to German banks. Obviously, Deutsche Bank is there within the top 10 with a 4% holding. But then you kind of go further down, and the next bank I'm seeing is Commerzbank with less than 1%. So it doesn't have a huge exposure to German banks. So I think that should be less worrying. Where you're seeing the biggest exposures are companies like Bayer, BASF. So you're looking at the kind of the chemicals, pharmaceuticals type companies there, and you got Siemens. Obviously kind of high-end electronics, and then you've got Daimler and Volkswagen, etc. So in terms of the other big financial that's in the top 10 is actually Allianz, but that's an insurance company. There isn't a huge amount of exposure to German banks within that index.
Okay, very well. And one final question. I think we're heading toward the end here. Heiko, this one's for you. If Germany's had such a good run in the past few years, as the Eurozone has really been struggling mightily, as we all know, and if, let's take the optimistic read on this, let's say the periphery is on the verge of some kind of a recovery here that's sustainable, why invest in Germany at this time if the expected returns are in Southern Europe, say, rather than in the heart of the Eurozone economy? Why not get the returns that are sort of there, the low-hanging fruit, so to speak? Can you address that, please?
Yeah, if you look at the medium term, and if you look especially at the debt on the different sectors of the economy, then you can see what you also saw in my presentation, that the debt level is on a sustainable level, and we don't need these adjustments in Germany. And for all the adjustment and the structural reforms that are needed in the peripheral countries, this will take some years to implement the reforms and to reduce the debt level, which had then a negative impact on the economic situation, on the GDP growth, on the growth figures, and we expect these also for the medium term to weigh on the growth rates in the peripheral countries. And also with the expected recovery of world trade, especially Germany's very open economy is benefiting from exports to emerging markets and to the United States. And with this is the other part we expect, that Germany is already in these markets. It's ready with the export, with the high quality products, and we do not see these structures in the peripheral countries. So that are the reason that we expect Germany to continue to outperform the other countries.
Very well. Okay, that's about all the time that we have. I wanted to say that before we sign off here, remember that you can all get the presentation 24 to 48 hours from now. So thank you for attending. I want to say thank you to Martin and Heiko, and I want to thank the audience for attending and for some very thoughtful questions. And on that note, on behalf of all my guests from Deutsche Bank and all my colleagues here at IndexUniverse, I'm Ollie Ludwig, wishing you all a very pleasant afternoon.